We have to wrap up, guys. And today I'm not going to do any revision. I want to get to the part that we haven't covered yet. Just probably for revision purposes, our last lecture we looked at the difference between direct and indirect taxes. We said a direct tax is imposed directly to the person, and we know persons is split into two groups again: natural person or individual, and also a juristic person. And indirect taxes, we said it is indirectly imposed on a person. Then we spoke about normal taxation, and today just to look at the year of assessment for an individual or a natural person. Guys, please bear in mind that if we say individual, we are referring to a natural person. Some books talk about individuals, others are talking about natural persons. It's the same thing. It's the same thing. Okay, so for an individual, we said the year of assessment starts every year on the 1st of March and it ends on the last day of February. Guys, this word here, last day of February, very important. If you write 28 February or 29 February, I might mark you wrong because it's the last day of February. That is for an individual. Then the company, for companies, we say that one, the year of assessment, and year of assessment is the name that we use for tax purposes for year end, okay? So year of assessment for companies is the same as the financial year end of the company. And guys, I think the reason for that is just for simplicity, so that when you actually prepare the financial statements, so that you also know what taxes need to be paid. I think that is the rationale why the year of assessment for a juristic person is also the year for the financial year end for financial accounting purposes. Then we looked at the tax framework. This is the framework. We said we will always start at gross income, and I told you last week that when we speak about gross income, it is not that gross income that you used to know, where you just tell me if I work and I get money, I'm earning income or stuff like that. Gross income in tax, it has its own definition. It has its own definition, and that is our next chapter. There's a whole chapter, chapter 2, that deals with gross income, a whole chapter just on gross income. And then, so basically this framework, if someone wake you up 12 o'clock at night, you should be able to tell them that. If they ask you, how do you calculate taxable income? You should say, gross income less exempt income gives me income less deductions, allowances, and amounts to be set off against income, add amounts specifically included in taxable income, such as CGT, and that will give me my taxable income. And guys, that taxable income, that is the income that will be taxed. And today, I think I didn't mention this last week. Today, I will show you how we will calculate the tax using this table. So please just bear with me. I just want to get to that part. So guys, today we will start with administration of the Act. We will look at the administration of the Act. But before we do that, let's quickly go to this little table here. Can one of you just confirm if you guys can see this annexure? Monetary values 2020. Can you guys see it?
Yes, sir.
Yes, we can see.
All right, thank you. So guys, in South Africa, they have different categories, and I'm talking about an individual. Remember, I told you this semester your focus will be largely on individuals, on a natural person. We will not look in detail at companies or at juristic persons. So for individuals, guys, there are 3 categories of taxpayers, which is persons under 65 years. In South Africa, the retirement age is 65 years. So there is people under 65 years. Then there's persons 65 but under 75 years, and then there's persons 75 and above. Now guys, I don't want to get into the politics of all of this. Some of you feel like, why are people that is 75 years Why do they still work? And some of you say that they are taking our jobs away. That is why the youth is actually unemployed. That's the one argument. And the other argument is that people that 65 and 75, some of them really looked well after themselves, and they are actually a hub of knowledge which we cannot lose, which we should transfer from. If you can link up with someone that is 65 years old and an accountant, go sit with them and ask them so that you can tap into that information or that knowledge, because I'm telling you, someone like that will be very, very wise. They have so much to offer, and that is why in South Africa they actually still allow these people to work. Of course, if they still work, they need to pay tax. Okay, they will also, and even if you don't work, we will see how it actually works out. Just wanted to give you the 3 categories. Now, guys, here you see the rates of normal tax for natural persons and special trust. Now, guys, this is still 2020. I'm going to give you 2021 in the exam. Now, guys, just for your purposes, I always give you this table. You don't have to study this by heart. I'm giving you this table in a test or in an exam if necessary. So please don't study this information. The reason for that is this information changes every year, almost every year. You will see today why I'm saying it might change every year, so it doesn't make sense for you to study this information. Now, maybe I also have these Namibia also have these tax tables. However, we don't have these 3 categories. We only have 1 category of people. If you earn money, you pay tax. Okay. So, guys, let's look at this table. Let's look at an example. Now, let's say your salary, and I want you to sit with your calculator or phone or whatever. Let's say your salary is 300,000 Namibia, 300,000 rands. Remember, we are working with rands. Let's say your annual salary, annual, that is for the year. You've earned 300,000 rand. Okay. So what we say is, we will now calculate that person's tax for the year on that 300,000. And let's say that person is under 65 years. It's you. No? Let's say it's you that is under 65 years. So basically what we say is there's a rebate of 79,000. Okay. There's a rebate of 79,000 or a threshold of 79,000. What that means is if you, since you're under 65 years, if you earn less than 79,000 for a year, then you will not pay tax. Now, guys, let's take 79,000 divided by 12. Do you guys get 6,583? Someone to confirm? Is that what you got?
Yes.
Yes, sir.
All right. So what that means is if a person under 65 years earn less than 6,583 per month, they will not pay tax. Okay, so if your salary is 6,583 or less per month, then you will not pay any tax for that specific year. However, if your salary is 6,584, for instance, every dollar that is more, you will start to pay tax. Now, guys, let's look at our example. Our example, I told you 300,000. So let's take 300,000 divided by 12. Do you guys get 25,000?
Yes, sir.
All right, so we can already see, so that person will pay tax since it's more than that 6,500. However, we want to calculate the tax for that person per year. Now, guys, this table here is called a sliding scale. A sliding scale, which means there's different tax bracket. If you earn between this and this is what you will pay. Now, guys, Our 300,000, do you guys agree it falls in this second category? Because 300,000 will be between, it will fall in this category since this category goes up to 305,850. We have 300,000, so obviously we fall in this category. Now guys, a person like that will pay, now this is the tax part, how much tax that person will pay. That person will pay a flat 35,253 per annum, plus that person will also pay 26% on every dollar that exceeds 195,850. And this 195,850 is always where the previous bracket ended. If you go to this third one, you will see it's 31% and always where the previous bracket ended. This one where the previous bracket ended. Anyway, ignore that for now. So guys, what does that mean? What we will do is, since our amount is 300,000, all you need to do is you will say 300,000 minus 195,850. So 300,000 minus 195,850. Do you guys get 104,150? And that you will multiply by 26%. And I think you get something like 27,079. That is the tax amount. So obviously we will have to add this 27,079 plus this 35,253. And you will see that that person, our person that earns 300,000 for the year, will pay 332. That will be the tax that that person pay per year. So obviously we can say divide by 12. So you will see that that person will pay $5,194 rands tax per month. And I told you that that person's salary is 25,000. Remember, we did that first thing. So 5,194 will go to SARS as tax. So you will actually only be left with, let's see, maybe 19,805, and that is what you will get in your bank account. Also guys, there's also other things that might still be deducted from this amount, such as pension, medical aid, and all of that. But I just wanted to show you that a person earning 25,000 in South Africa will pay 5,194 tax. That is your tax that you will be paying. Obviously guys, it's not that simple. There's also rebates and all of that, but we will discuss it a little bit later. Now guys, before I continue, I quickly want you to ask questions relating to this calculation that we just did. I just want to reiterate why I said 300,000 minus 195,850. If you look here, you will see they say that person will pay 35,253 plus 26% of the taxable income exceeding 195,850. So basically what they say is every dollar more than 195,850 will be taxed at 26%. And that is why we said 300,000 minus 195, and we got an amount there. We had to multiply that by 26%, and that is the amount we got. So that plus that is the tax for that specific year. Any questions relating to this calc before we continue? Do we all understand how we got that amount? It's easy, right? Or anyone that wants to ask a question?
Yeah.
Yes, go ahead.
Can sir please explain again what the 35,000 means, that the highlighted one?
That is a fixed amount. If you go to, thank you for your question. If you go to all of these, guys, these taxes here, this is what is set by Parliament. This is what the Parliament agree on every year. They decide to say, listen here, people earning between $0 and 195,850, but also, you know, this thing here, deducted, but anyway, they will pay 18% tax. And you see there's no fixed amount here. That is probably just to help those people who earn less. Remember, we said tax work on a progressive system. The more you earn, the more tax you pay. Imagine, it's almost like you are punished for making something with your life, or for working harder and for earning more. It's almost as if you are punished. But that is just how life works. The more you earn, the more tax you will pay. But anyway, to get to your question, where does the 35,000 come from? These amounts are fixed. That is why I said I'll give you the table. These amounts are fixed. So basically what they say is, for this bracket, you will pay a fixed 35,253 plus, you must also work out 26% of every dollar that exceed the 195,850. And that is why we said 300,000 minus 195,850. Then we multiply it with 26% to get this 27,079. But we also have to add that to the 35,000 so that we can get the full amount. But just to answer you again, these amounts here are fixed. You don't calculate them. They have calculated for you already. You just need to calculate the additional amount that is that you need to still work. Do you see these percentages go up? 26, 31, 36, 39, 41, 45. The more you earn, the more tax you will pay. Ma'am, did I answer your question?
Yes, sir. Thank you.
All right, thank you, Loida. Anyone else that want to ask a question before we continue relating to that? Do we all understand how I got it? All these amounts, guys. You can practice. Yes, go ahead. Sorry,
sir.
Go ahead.
So let's say if I'm earning I'm earning, for example, 200,500 per year, how I'm gonna pay the tax?
What is the amount that you gave? 200?
200,500.
Okay, 200,500. Yes, thank you. Let's do that one quickly for the sake of time. Just that one. He said, what if my salary is 200,500 per annum? So what will we do? Step one, we will look at where does 200,500 fall, and I can see it falls in this bracket again. Why? Because this bracket say 195,851. Between 195,851 and 305,850. People that earn between these amounts will fall in this bracket. Now, do you see 200,000 fall in that bracket? It can't be that one. It can't be this one. So it's that one again. So do you agree with me? Yes. In that case, we'll have to pay a fixed 35,253 again, plus 26% of all the amounts exceeding 195,850. Now, what do we do with that? All you do is you just say our 200,500 minus 195,850. What do you get? Let's see quickly. 200,500 minus 195,850. That gives me 4,650, and then obviously I need to multiply that with 26%. So multiply by 26%, and I think I get 1,209. So that is also an amount that I need to add. 1,209 plus 35,253. So if I add this to 35,253, I get 36,462. That is the tax for the year for this person. If I want to get the monthly tax, I just divide it by 12. So which means this person will pay $3,038.50. That is what, or rand, sorry. I'm so stuck with this Namibian dollars. So it's rands. 3,038.50 cents. That is what this person will pay. Did I answer you, sir?
Yes, sir. Thank you so much.
Yes, you guys can go practice at home. All of you guys, for the sake of time, we have to move. You can practice at home. Give yourself 1.5 million. Dream about your salary. Now, these are your salaries. Any amount, and then you use this table to see, to get an idea of what your tax will be on a monthly basis. Now, guys, let's start with the administration of the Act. Let's start with the administration of the Act. Just to see here. Okay. So what I wanted to say earlier is this part. Normal taxation is fixed annually by Parliament. What do I mean with that? I told you guys earlier, these amounts are set by Parliament every year. Fixed. Yeah? Guys, you can see some, do you see 2019, 2020? It even went up. It used to be 78,150, then it went to 79. Do you see? Parliament decide on these figures here in all of these brackets on an annual basis. That is what that statement means there. It is fixed annually by Parliament. So government, the Minister of Finance makes some suggestions, and then Parliament need to adopt or they need to reject that. And once it is gazetted, then we will have a new table. And that is why I told you, you don't have to study this. This is normally at the end of your test. Guys, the test that this is even a previous year test paper that I'm having there open, because I just wanted to show you that I normally give you this last page so that you can calculate these figures. You will see there's also other things that we will later look at, such as travel allowances and all of that. Anyway, just to state what this means. It's fixed by Parliament every year. Now, the determination of taxable income is the first step in the calculation of a taxpayer's liability for normal tax. Remember, we said step 1 is to get to taxable income. Step 2 is we will now tax that income that we've calculated here. So step 1 is to calculate a taxpayer's taxable income, because that is the income that you will be allowed to tax using these sliding scales here. But step 1, calculate the taxable income. Once we have the taxable income, we will go to this table to see how much tax will be deducted from that income. It basically means that that income will be taxed, and that is the amount that we will calculate. Now, South Africa make use of a residence-based tax system, guys. I already spoke to you about this. So residence basically just means that if you are a resident in South Africa, you will pay tax on your worldwide income. Remember, we spoke about worldwide income. Now, I will look at income, direct and indirect taxes. Remember, we already defined what income is, guys. Basically, we will just be working around this framework all the time. If I say define income, then you will have to tell me income is gross income minus exempt income. That is income for tax purposes, and that is what I told you here. As defined in the Income Tax Act, the Act meaning gross income less any applicable exemptions, and that is what will give you income. So if I say define income for tax purposes, you need to tell me it's gross income minus exemptions or exempt income. Now guys, let's look at the difference between direct and indirect taxes. I already told you. A direct tax is one paid directly to the government by the person, and persons is juristic or natural. And an indirect tax is basically one where you don't pay it directly. Now let me just mute everyone because you are disturbing me. All right. So on whom it is imposed, often accompanied by a tax return filed by the taxpayer. So guys, what we say, a direct tax, that is one that you pay directly, and it basically just means that you must also fill in a tax return. I'm sure you guys have heard of a tax return. Our purpose is actually to calculate the figures that needs to go to the tax return. Examples of direct taxes include corporate taxes, transfer taxes such as estate or inheritance tax, and even gift tax. Now guys, another name for gift tax is donations tax. Let's look at indirect taxes. Indirect taxes, as an indirect tax such as sales tax, value-added tax, or goods and service tax. Now guys, just to give you a background, before a lot of countries introduced value-added tax, they actually had a tax called goods and service tax, GST. Some countries still make use of GST, while a lot have moved away from GST, and we now instead use value-added tax. You will see, just Google after class, you will see that there are some countries that still use GST. But most countries like South Africa and Namibia, we are using value-added tax. Okay, now these taxes is a tax collected by an intermediary. Like I said, Pick and Pay is the one that deduct the 15% or that needs to pay over the 15% to the government, such as a retail store, from the person who bears the ultimate economic burden of the tax. Now guys, indirect tax, it is a consumer tax, it's a consumption tax, which means the end user is paying for it. You and me is paying for it because we are consuming that item at the end of the day, and that economic burden will be placed on us. Now let's do this activity quickly. Now I know you have the slides open in front of you, so we will not spend too much time here. Taxes can be divided into direct and indirect taxes. Determine if the following taxes are direct or indirect. Income tax, easy. That's a direct tax, right? And then value, guys, income tax is the one that you pay on your salary for natural persons, and for a company or corporation, that will be your main tax that you pay, corporation tax, because it's tax that you pay on your income that you've earned. Remember, when you are employed at a company, the aim is that you make money. If you work for free, then maybe that should be called an internship or something like that. Even internships will give you money sometimes. But if you are employed as an accountant, the aim is to make money. So to make income, and your income tax, that is the main tax that you will pay. That's direct. And then, and value-added tax is indirect. Donations tax is direct again, and transfer duty is indirect. Now guys, with transfer duty, that is when you sell your house. Even in Namibia, we also have this tax. There's a smaller portion that they call transfer duty that you will have to pay. Now guys, let's look at the difference between the residence and source again. Residence versus source-based tax systems. Now, a resident is defined in Section 1 in the case of a natural person of the Income Tax Act as either. So this is how they define a resident in the Income Tax Act in Section 1. They define it as a person who is ordinary resident in South Africa, or a non-resident who has spent a certain number of days in South Africa, and often we call this the physical presence test. You have been physically present, yes. Maybe you are not an ordinary resident. What does ordinary resident mean? We have to define that later. You will see, we will define it in chapter 2, but we will see. Basically what it means is, if you are not an ordinary resident, you see this all here, and you are a non-resident, then we will even look at the physical presence test to see, have you been physically present in South Africa, so that we can tax you as well. Now, residence is founded on the premises that because the taxpayer enjoys the comfort and the protection of the country in which he resides, all of his income, so his worldwide income, should be taxed in that country. So guys, that is actually the reason why we pay taxes, because we say you are enjoying our protection, you are enjoying our beautiful sunshine, even though it's not ours. It's coming from a higher power or whatever you believe in. But we say, because you are in our country, you are enjoying the peace, the stability that you see here, you will have to pay tax as a resident. Source, now let's look at source. That was now resident. Like I said, guys, ordinary resident, physical presence, there's all these things will be defined. We will explain it to you in chapter 2. It's actually a very long process to determine whether someone is an ordinary resident or even a resident in terms of the physical presence test. Now let's look at source. Source is based on the premise that because the resources of the country give rise to the income should be taxed in that country. Guys, Namibia is using a source-based tax system where we say, if you use our resources in this country, you will be paying tax because you have used our resources, and it is our resources that gave rise to that income, and therefore you will pay tax. Now, guys, just for interesting sake, a source-based tax system is a very weak one, and yes, depend on Namibia to choose it, of course. There's a lot of room for there's a lot of loopholes. People can manipulate that system. It's not very strict and all of that. So that is why I made that comment last week where I said after 31 years, I think as Namibia, as a country, we should also move to residence-based tax system. It's more residence-based tax system is more strict. It's better. There's less loopholes for people to evade and to run away from the obligation to pay tax and all of that and so forth. Anyway, normal tax is often referred to as income tax. So guys, when I say calculate the normal tax, just know I'm talking about income tax. So I can either use income tax, the word income tax, or I can say normal tax. And like I said earlier, when we did this activity, when you earn a salary, guys, then the purpose is for you to make income. And I think that is why they somehow want to call it a normal. It's like the very normal one. Because you are working, normally you will have to pay tax on that. And of course, if you earn more than the threshold. Guys, the reason why there's a threshold is so that people that earn less than these amounts don't have to pay tax, because government's argument is they really earn too little. And guys, let me just show you the difference. Remember we said earlier that it's 6,583 or something. So in South Africa, if you earn less than 6,583, you don't pay tax. In Namibia, the amount is 4,166. That is ridiculous. Imagine if you earn 4,167, you already pay tax in Namibia. It is ridiculous, because $4,000 is really not money. But the difference between the two countries, South Africa, larger economy, okay, and also a higher unemployment rates. That is why it's actually so high. The reason why there's thresholds is so that we can basically you exempt those people that earn less than the threshold so that they don't have to pay tax because they already earn so little. Now, guys, the premise or the reason why we pay tax, if you want to go argue with someone, please go argue with Mr. Adam Smith. Please don't argue with me or with the government or anyone else. It was Mr. Adam Smith that was actually a lot involved in terms of this whole paying of taxes, and he even came up with 4 basic principles for paying taxes. He came up with 4 basic principles. He said that anyone that pays tax, the tax system or any tax system should abide by these 4 basic principles, okay? And the first principle is in proportion to their income. Do you see, guys? They say if you earn less, you must pay less tax. If you earn more, you must pay more tax in proportion. So kind of, to me, this look like, it seems like it should be a bit fair in terms of equity and all of that. So basically, people earning more should pay more tax, not only more by amount, but also according to percentage. And then A person who earns lower income should be paid or should be taxed at a lower percentage, while high earners should be taxed at a higher percentage. And guys, this is the reason why I said earlier, it's almost as if they say because you're earning more, it's almost as if you are now, that's one way to look at it, as if you are now punished for earning more or for making something of your life. Because someone who don't study and who is not in this class right now, maybe they don't want to study and stuff like that, but you are taking steps to become a better you, isn't it? And because of that, it seems like now that you earn more, you also have to pay more taxes. However, guys, that's one argument. The other argument is in terms of fairness. If you earn more, it's just fair that you contribute more tax. Imagine if you earn $10,000 and I earn $5,000, and if the government now say both of us have to pay 1,000 Namibian dollars tax. That would not be fair towards me because I'm only earning 5 and you earn 10. Okay, there's even a Bible if you are religious, or if you're Christian, there's even a Bible verse on that says that we need to always apply equity in terms of if the lady that only had that coin, she actually gave more than the other people because she gave her last. She gave her everything, a last. So that's one thing. Just on that argument again, please take note, there are certain cases, there are certain scenarios where us professionals, where we are also, I almost want to say, where we benefit. Let me give you one example. Let me just give you the nearest example that I can think of at Old Mutual. Let me just take that one. If you take out a life cover policy, as a professional, someone with a degree and all of that, you will pay less money because they say you have a less riskier job as an accountant. Let me take myself as an accountant. You have a less risky job. What do I mean of less risk? I don't have to climb on a ladder to teach you or whatever the case might be and all of that. Also my qualifications, because they know I've also worked hard to get those qualifications and all of that. So for $1 million Namibian dollar cover, I might pay $200, while someone without a degree might have to pay $350. And do you see there, what I'm trying to say is there are also benefits. So don't get discouraged to say now after class, since I'm going to pay more tax, I don't want to continue my studies because I'm being punished. No, there are benefits. There are benefits. The second principle is certainty of amount. So someone paying tax, they should always be sure of the amount. And guys, that is why government fix these tables every year. These tables, you will find it anywhere. You will find it on this on Google. The government will make announcements. You can even go to the receiver of revenue's office to say, give me the tables. This information is free and easily available to anyone. Why? Because we should be sure that we should have guidelines of the amount that we need to pay. Certainty. We should know for sure what is the amount that we should pay. So the receiver of revenue should have specific tax tables so that taxpayers can calculate the tax payable. The way and time to pay these taxes should also be clear. So when should I pay these taxes? Do you see the year of assessment for an individual? 1 March to last day of February. So that is giving us this thing of when should taxes be paid and stuff like that. So we should be sure of what amounts to pay. The third one is convenience. So the time and way taxes should be paid should be convenient for the taxpayers. So we say salary taxpayers normally pays their taxes every month, while non-employees pays twice per year. So non-employees such as guys and CEOs and those ones also sometimes fall under this category of non-employees. Why? Employees. Why? Because they are referred to as provisional taxpayers. Provisional taxpayers only pay tax twice a year, but obviously, guys, it's going to be a large amount, isn't it? Imagine if you have to pay 35,000 per year, and you only pay tax twice a year, it will obviously be 35,253 divided by 2, which means first they will deduct around 17,000, and the next one 17 again, which is big, isn't it? If it's monthly, at least it will be 2,000 per month and things like that. Okay, so convenience, the time and the way taxes should be paid should be convenient. Now, guys, in Namibia, we finally came to the party. We have an online system. Next year in Tax 310, I will introduce you to the system. I'll show you how to submit your tax returns online. Some of you might do it already. Good for you. Okay, but I'll show the class so that you know. And an online system is a very convenient system. You know, I know a lot of Namibians still argue and say that this new system is difficult to understand and all of that. I'm telling you, it literally took me a few days to realize that it is actually exactly like the manual system. The only thing is that it's now online and it's actually much more convenient. It's very convenient to submit your tax returns online. There's a business opportunity for you next year when you graduate. You can offer clients to do their tax online, because some people know how to do these taxes, but they don't know how to do it online. That can be your business venture. Is it sustainable? I don't know. You will have to look, because everyone else will probably in future be able to do it online. That is how easy it will become. The last one is as little as possible. Can you believe it? The government actually say that they tax you as little as possible. They always try to tax you as little as possible. This is debatable. It's definitely debatable. But according to the government, they tax you as little as possible. So the taxes imposed on a person should be as little as possible. The state should not and does not attempt to bankrupt people. Definitely debatable, but in their heads, they say that they actually pay you, they actually tax you as little as possible. Then, guys, for our next lecture, you are supposed to read chapter 2 on gross income in your prescribed textbook, which is Notes on South African Income Tax. Please read that chapter. It's a very long one. We will be busy for 3 weeks with gross income. You will even do a case study presentation that you will have to do on chapter 2. So please pre-read gross income. If you don't have a prescribed textbook yet, go to YouTube, type in gross income South Africa. Please make sure that you choose South Africa. Listen to some videos, guys. There's a lot of videos. UNISA and all these universities, they have some lecture material there. You can listen to that, but there's no reason for you not to do pre-reading. Remember, you don't have to understand what you read. You must just get a foundation, a background of what that chapter will be all about. This is my references for this lecture. This is what I've used. So, like I said, when I give you an assignment, I want you to include your references. We are done with this chapter. There's still 9 minutes remaining. I will now open the floor for any questions before we conclude this lecture. Any questions?
Sir,
Yes, go ahead, please.
sir, what will happen if one doesn't pay tax?
Thank you for your question. That's a very good question. What will happen if one does not pay tax? It's actually a criminal offense. It's a criminal offense, and you can be, you can actually go to jail for it. One of our last chapters deals with tax evasion and tax avoidance. And the one is legal and the other one is illegal. And there you will see what is the penalties in terms of how long can you go to jail. Sometimes they will require you to pay back the money, or they will freeze your assets. They will sell your assets if you have any. If you don't have assets, of course, then you will probably go to jail. Let me just give you an example. Cristiano Ronaldo, the soccer player that currently play at in Italy. He had a court case where they've evaded to, or basically didn't pay enough tax, and he got a 23-month, you know, basically penalty, 23-month that he needed to go to jail or whatever. I'll send you that video. But because the Spanish law is basically say that if you get less than 24 months, then you don't have to go to jail. He just needed to, obviously they negotiated and stuff like that, and he needed to pay back that money that they actually determined that he did not pay as taxes. It's a very interesting video. I'll definitely send it to you guys during the course of today, where you can just listen to one example. There's also a court case of Lionel Messi, which is another court case of tax evasion. But the short answer is you can go to jail because it is a criminal offense. Is that okay, Josevita?
Yes, sir.
Yes, sir.
All right, thank you. Any other questions? Any other questions?
Yes, I have a question.
Yes, Jeremiah, go ahead, please.
Yes,
Also, I wanted to ask.
Oh, sorry, it was not Jeremiah. Let's first give to the other gentleman, and then we'll give to Jeremiah. Sorry about that. Please go ahead, student.
At high school, I taught that the government sometimes may charge a regressive tax, whereby the low income earners would pay high in tax, and the high income earners would pay low. My question was, I wanted to ask if such kind of things do exist in Namibia.
All right, thank you, Joy. That's a very good question. Just to give the class a background of, you spoke about you said regressive system. So there are two types of systems. We have progressive and regressive. And progressive is basically the one that we looked at so far, where the more you earn, the more you will be taxed. And his statement is very nice because it looks at regressive, where people that earn less is actually taxed more. So you see the flip side of it. So the question is it also available? Is it also in Namibia? The answer is no, although it sometimes seems like it. Let me give you an example where it seems like it. In terms of value-added tax. Value-added tax is very unfair. Why do I say unfair? Because everyone pays that 15%. Okay? Whether you earn 20,000, whether Mr. X earns 100,000. When we go to the shop, we have to pay 15% VAT. There's no distinction in the income and all of that. However, how the government argue in that stance is they say that if you earn less, you will not buy so much, and that is why the 15% is apparently fair. However, that is probably one example where I can tell you that it actually I almost want to say it yields to a regressive system where people that are poor actually pay more than people that are actually rich. But it's definitely, I cannot say with conclusion that it is actually available in Namibia or applicable in Namibia. It's not. The short answer is it's not, but those are some of the things that you can look at. And if you do your honors degree in 2023, then we can actually embark on research, on tax research, to see, you know, whether regressive tax systems is applicable in Namibia. Okay. Any other questions? Joy, I hope I've answered you. Any other questions? Jeremiah? All right, Jeremiah, go ahead.
Sir, I wanted to
Yes.
ask about the legal, what is it, legal tax or something? I'm not sure about it, but it's apparently a lot of business people, they don't pay tax through a legal way. They what's the right way?
I get you.
Yeah.
Thank you. Thank you. I'll explain to you.
Apparently.
Thank you.
Okay.
Please go ahead. Are you done?
If you understand, you can explain it, sir.
Yes, I understand. Thank you. So like I said, guys, our last chapter this semester deals with tax avoidance and tax evasion. Now, guys, one is legal and the other one is illegal. Tax avoidance is legal. Why do I say it's legal? Even in the textbooks and so forth, you find legal ways, and I think that is your question. So you find legal ways to avoid paying taxes. Let me give you one example. Our time is almost up, but I'll try. In Namibia, normally by 28 February every year, what tax experts do is they look at the client's books and they say, listen here, you will pay a lot of tax. I just looked at your income and all of that, and you didn't pay enough provisional taxes and all of that. So I think you quickly need to run to BMW, go buy a BMW today. Okay, the reason for this is if you buy it before the end of the year, you can claim 1/3 of the purchase price for tax purposes. Now that is a legal way because it's in the law that you can claim 1/3. However, if they buy that vehicle, even if it's on account and all of that, you can claim that 1/3, and obviously it will reduce your tax burden. That's a legal way. It's a total legal way to avoid paying so much tax. Okay, but tax evasion, that is illegal. Tax evasion is the one where I told you about Cristiano Ronaldo and Messi and all of them. It was found that they've actually evaded to pay tax, and that is illegal. We will talk a lot about this in our last chapter, Jeremiah, where I'll give you more examples and all of that, how you can actually avoid paying taxes in a legal way. In a legal way where you won't go to court because the act, you are basically challenging the act to say, this is not clear and therefore I didn't pay that tax. You will see in our next chapter, we will talk about your ipsi dixi, which is your own words. You need to express in your own words why you think an amount should not attract tax or why it will attract tax, and the government will listen to you. In your own words, you will have to explain to them, and that is legal ways of you avoiding to pay tax. Unfortunately, guys, our time is up. We will have to end there for today. Jeremiah, are you happy? And then we will continue.
Yes, sir, I'm happy, but I have a last question. So I want
Yes,
to ask,
ask.
why does this tax